Hey everybody, welcome to the channel. The US national debt just crossed $36 trillion. Yes, that's 36 with 12 zeros. We now spend more on interest payments than we do on the entire Department of Defense. And the debt isn't shrinking, it's accelerating. But here's the deeper issue. Most of what you've been told about the debt, how to solve it, whether it can even be solved, misses the point entirely. Because the truth is, we're not in the same world as we were the last time a US president actually reduced the deficit. The math doesn't really work that way anymore, and if you look at the numbers today, we have only a few options to actually accomplish this. So today we're going to talk about something suggested by one of the awesome people in our community, the US national debt. But before we do, if you find any part of this video helpful or insightful, please like and subscribe, it really helps out the channel. The national debt has become the default political football. Some argue it's an existential threat, others say it's a non-issue in a sovereign currency system. But here's what can't be debated. The numbers have changed, the global environment has changed, and the options to combat it have narrowed quite a bit. In this video, we're going to dive deep into four things: what the national debt actually is and what it isn't, whether it really needs to be solved, how the US compares to other nations, and the only realistic way the US can meaningfully reduce it. Let's start this discussion with some hard numbers. The US national debt stands at over $36.2 trillion. Debt held by the public is now about 99% of GDP, on track to hit 116% by 2034 and 172% by 2054, if current policies stay in place. This year alone, we're running a projected $1.9 trillion deficit. That's nearly 7% of GDP, and interest payments are expected to approach $950 billion in 2025, nearly surpassing defense spending and accounting for roughly 14% of the total federal budget. A massive jump driven by higher rates and a larger debt base. Let's put that into perspective. Interest is now one of the largest line items in the entire federal budget, larger than education, transportation, and veterans benefits combined. And with rates at their highest in decades, that number is only going to go up as we refinance old debt. Historically, low interest rates masked the real weight of the debt. But now that we're living in a higher for longer rate regime, the cost of servicing the debt has become inescapable. And the bigger the debt gets, the more sensitive we become to even small increases in rates. Now don't be misled here. The US has had high debt before. During World War II, debt rose above 100% of GDP. But that debt was funded domestically, controlled by war bonds, and was followed by massive post-war growth, financial repression, and a baby boom that expanded the tax base. In the 1980s, debt surged again under Reagan, driven by tax cuts and defense buildup. But inflation was falling, interest rates were coming down from record highs, and globalization was kicking into gear. By the 1990s, those tailwinds helped shrink the debt to GDP ratio. Today, none of those dynamics are in our favor. Demographics are aging, globalization is retreating, and interest rates are structurally higher. We're not borrowing into a boom anymore. So what is the debt comprised of? Well, there are two broad categories of US national debt. Intragovernmental holdings, this is the money that the government basically owes itself. Think Social Security and Medicare trust funds. It's not irrelevant, but it doesn't present the same economic risk. The second one is debt held by the public. This is what's borrowed from investors, individuals, pension funds, foreign governments, and central banks. It's this portion that requires interest payments and can trigger market instability if confidence starts to erode. I want to start all of this off by saying that national debt isn't inherently bad. It's not like credit card debt. And I think a lot of people try to think about it in that way. Borrowing to fund infrastructure, education, or stabilize the economy during a crisis makes sense. But when borrowing becomes routine, year after year, regardless of economic conditions, that's when it begins to constrain future options. In 2001, the US had a debt to GDP ratio of 55%. By 2010, it was 90%. Today, it's nearly 100%, and the trajectory is steep. Why? Well, a combination of tax cuts, war spending, financial bailouts, entitlement growth, pandemic relief, and structurally unbalanced budgets. Let's also break down how the debt is actually managed. The Treasury issues bonds with different maturities: short-term bills, medium-term notes, and long-term bonds. As older debt matures, it gets rolled over at current interest rates. If those rates are higher, the interest burden rises. This rollover risk is one of the reasons the debt becomes more expensive over time. Another factor that exacerbates US debt anxiety is the recurring drama around the debt ceiling. You know what I'm talking about too. Every so often you'll see the same headlines over and over again. Well, the US is one of the only developed nations with a legal cap on total borrowing. This limit doesn't actually control spending, Congress does that, but it does create a legal limit on the Treasury Department's ability to issue new debt. Every time we approach that ceiling, we flirt with the idea of just letting the US default. And every time, global markets hold their breath. During the 2011 standoff, Standard & Poor's downgraded US credit for the first time in history. In 2023, we came within days of default again. These political games damage confidence and add risk premiums to Treasury yields, hence why I very carefully and intentionally chose the word drama. But how does the US debt compare globally? Well, take Japan for instance. Their debt to GDP ratio is over 260%, making it the highest among advanced economies. Most of that debt is owned domestically, with the Bank of Japan holding around 43% of government bonds. However, unlike past decades, Japan is no longer experiencing near zero inflation. As of early 2025, headline inflation is running around 3.7%, consistently above the BOJ's 2% target. The central bank has responded by raising interest rates to about 0.5%, which surprisingly is its highest level in 17 years, and is signaling further hikes if inflation persists. Despite these shifts, Japan remains relatively stable due to strong domestic demand for government bonds and a persistent current account surplus. Let's look at another country. Italy's ratio is around 140%, but is part of the Eurozone, which means it can't print its own currency, which adds pressure from the markets and Brussels. What about China? Well, its reported debt looks moderate, but local government borrowing and off-book liabilities paint a more risky picture. Beijing also tightly controls capital flows, insulating it from a sudden flight of investors. Emerging markets like China or Turkey face harsher limits. They can't borrow in their own currency or issue debt on demand. If confidence erodes, they default. That's not the US yet, but comparison shows the privilege of dollar reserve status. The US definitely benefits from issuing the world's reserve currency. US treasuries are still seen as the safest asset on earth, and that gives us quite a bit of leeway, but confidence is a pretty fragile thing. A sudden loss of trust in US fiscal management, or a default scare from a debt ceiling standoff, could trigger a flight from treasuries, spiking yields, and ignite a fiscal spiral. Now you might be wondering, who actually owns the US debt? Well, roughly 1/3 of publicly held US debt is owned by foreign entities. Japan and China are the top two holders with a combined $2 trillion. Other major creditors include the UK, Switzerland, and some Caribbean banking centers. This creates geopolitical risk. If relations with China continue to deteriorate, Beijing could slow its purchases or completely divest its holdings. That would pressure Treasury yields higher, forcing the US to offer more attractive rates to fund the same borrowing. And we're starting to see some of this happen in real time. Some evidence suggests that China has started offloading some of its $760 billion worth of US treasuries back onto the open market. This move isn't just about economics, it's also a geopolitical strategy. The immediate impact? Well, long-term bond yields have jumped, with the 10-year surpassing 4.5% and the 30-year briefly breaching 5%. Why does this matter? Well, higher bond yields ripple through the entire economy. They raise borrowing costs for the government, pushing interest payments even higher. They also tighten financial conditions for households and businesses. From China's perspective, this puts pressure on the Trump administration to relax with all of this tariff talk. Beijing likely believes that this is one of the few pressure points where the US remains vulnerable, our addiction to cheap debt. If long-term yields keep climbing, it not only increases the cost of new borrowing, it compounds the rollover risk on the trillions of short and medium-term debt coming due. To be clear, China dumping treasuries hurts them too by devaluing their holdings. But our reliance on foreign financing adds a layer of complexity that debates on the topic here in the US often ignore. So let's break down the drivers of debt growth. What got us here? Well, first, we have some mandatory programs. Social Security, Medicare, and Medicaid now make up nearly 2/3 of federal spending. These are politically untouchable and growing faster than GDP. Next, we have interest on existing debt. As mentioned, debt service is exploding. We're refinancing $7 to $8 trillion in low-yield debt into much higher rates. Another big one is defense spending. The Pentagon's budget has grown from $600 billion in the early 2010s to nearly $1 trillion today. That's more than the next 10 countries combined. We also have tax revenue shortfalls. Tax cuts in 2001, 2003, and 2017 all lowered revenue relative to GDP, and Congress keeps extending them. Last, we have crisis spending. The 2008 financial crisis and COVID added trillions in emergency relief. Much of it was necessary, but it wasn't followed by fiscal normalization, which is the problem. Now, some argue that debt doesn't matter because the US issues its own currency. This is the premise behind modern monetary theory, which is something we've talked about before. Proponents say the government can't go bankrupt in dollars it prints, so it should really worry about inflation, not debt. But even modern monetary theory acknowledges real limits. Inflation is one, credibility is another. If investors believe fiscal and monetary policy are disconnected from reality, they demand higher returns or exit the bond market entirely. Now, we're not there yet, but the window for experimenting with unlimited deficits might be closing. Even the Fed has acknowledged the long-term unsustainability of current fiscal paths. So let's talk about some solutions. Most people love to say, just cut spending. But what does that mean? Most of the budget is either mandatory or politically protected. Here's the breakdown. As we talked about, we have mandatory spending, Social Security, Medicare, Medicaid, and interest. Any cuts here, that's not going to go well. Then we have defense. This is kind of the only major pot of discretionary funds large enough to matter. Then we have non-defense discretionary, which includes education, infrastructure, science, housing, transportation. Cutting here won't move the needle too much. So that really just leaves the military. And yet the 2025 budget increased defense spending from $850 billion to nearly $1 trillion with bipartisan support. So when people talk about cutting the debt without touching entitlements or defense, they're either lying or don't actually understand the math. Here are the actual levers available to us. 1. Cut military spending. This is politically unlikely but mathematically impactful. Second, we can raise taxes, especially on high earners and capital. This could include wealth taxes, VAT, or closing loopholes, but it does raise some political resistance. Third, we need to boost growth. Higher GDP can shrink the debt ratio, but it would need sustained 4 to 5% growth for a decade, which is highly optimistic. Fourth, we could monetize the debt. Let the Fed buy more treasuries and suppress yields. Problem with this is that it risks inflation and a loss of dollar credibility. Fifth, we can let inflation run rampant. We can inflate the debt away by running prices higher than interest rates. The problem with this, of course, is that it punishes savers and risks stagflation. Sixth, we can restructure entitlements. This means raising the retirement age, adjusting cost of living formulas. Problem with this is that it's politically toxic, so unlikely to ever happen. Our last option is simply to do nothing. Kick the can. Let debt keep rising. Hope markets tolerate it. Eventually, something's gonna break. None of these are great choices, and all of them involve real trade-offs. But let's game this out. What happens if we do nothing? Well, if we do nothing, interest rate payments are gonna crowd out discretionary investment. This is things like R&D, infrastructure, education. Another thing that's gonna happen is private investment is gonna fall as the government absorbs more capital. Third, treasury auctions become more fragile and liquidity erodes. The fourth thing that happens is the Fed gets trapped. Raising rates causes fiscal panic, but lowering rates fuels inflation, so they really don't have anything they can do. The last thing that's likely to happen is that markets lose trust and the US faces a debt spiral where rising rates just lead to more debt. This isn't imminent, but it's not really theoretical either. The UK faced it in 2022 under Liz Truss, Argentina lives it every day, and even the US faced it during the 2011 debt ceiling crisis when Standard & Poor's downgraded our credit rating. What a lot of people don't realize is that debt isn't just a number. It's a reflection of our priorities as a society. We've chosen not to raise enough revenue to match our spending. We've chosen to preserve all mandatory programs and grow the Pentagon. We've chosen short-term politics over long-term solvency. And that's the real issue. Not whether we can solve the debt, but whether we really want to, whether we're willing to. So can the US solve its national debt problem? Well, I think it can only happen if we're honest about what solving it would actually take. Cutting the defense budget, raising taxes, or overhauling entitlements. Until then, we're likely going to keep borrowing, the world is going to keep lending, and the bill is going to keep growing. Guys, if you enjoyed the video, please hit the like and subscribe button. It really means the world to me. I'd also love to hear your thoughts on this. What's your take on the US national debt? So please feel free to leave a comment below. And until next time, have a good one.